if I find multiple price action confirmations or confluence following these criteria, I seriously consider making a larger transaction. And like the first example that illustrated a high probability buy signal, this is a high probability sell signal. If I come across a trading signal like this or similar to it, I would consider entering a larger position, because the likelihood of achieving substantial profits is very high. You can verify this yourself in the forex, stock, or crypto markets. Hey guys, welcome back to another episode. Understanding money flow index analysis is crucial for successful trading. It's the backbone of making informed decisions and ultimately earning maximum profits in any market. Without a solid grasp of money flow index and market trend analysis, you might find yourself losing money or struggling to grow your investments. In today's video, I'm here to reveal everything about the money flow index and the best moving average setups that you probably never knew. We will thoroughly examine the money flow index, determine the best moving average settings when combined with the money flow index, read candlestick charts, identify the best support and resistance levels, recognize trends, and execute entry patterns correctly. I've condensed over a decade of my trading experience into this one comprehensive guide. And best of all, it's free. So, hit that like button to support the channel and subscribe if you're new here. Let's dive in and boost your trading skills together. What are the best indicators in stocks, crypto, and forex trading? To determine the best indicators, it's essential to understand their purpose. Indicators are mathematical formulas that analyze market data from various perspectives to reveal market conditions. Some of the most widely used and effective indicators include the Money Flow Index, or MFI, Exponential Moving Average, or EMA, Moving Average Convergence Divergence, or MACD, Relative Strength Index, or RSI, Commodity Channel Index, or CCI, and Bollinger Bands. And now, what is Money Flow Index? The Money Flow Index, MFI, is a technical indicator used in trading to measure the strength of money flowing into and out of a security. It combines price and volume data to provide insights into buying and selling pressure over a specific period, typically 14 periods. Here's why it's considered a valuable indicator. First, measures buying and selling pressure. The MFI calculates a ratio of positive money flow to negative money flow, indicating whether a stock is overbought or oversold. This helps traders gauge the intensity of market sentiment. Second, overbought and oversold conditions. Similar to the Relative Strength Index, or RSI, the MFI is scaled from 0 to 100. Readings above 80 typically suggest overbought conditions, potentially signaling a price reversal or correction. Conversely, readings below 20 indicate oversold conditions, suggesting a potential buying opportunity. Based on my observations as a trader who interacts with trading charts almost daily, the overbought and oversold conditions calculated by the MFI formula are more accurate compared to RSI and the stochastic oscillator. However, it's possible that you may have a different viewpoint. Third, confirmation of trends. The MFI can confirm trends identified by other technical indicators or price action analysis. For instance, if a security is trending upwards and the MFI shows high readings above 50, it suggests strong buying momentum supporting the uptrend. On the other hand, if a security is in a downtrend and the MFI line falls below 50, it indicates significant selling pressure that reinforces the downward movement. Fourth, divergence signals. Divergence between price action and the MFI can indicate potential reversals. For example, if a stock's price is making higher highs while the MFI is making lower highs, bearish divergence, it may signal weakening buying pressure and a possible trend reversal to the downside. Fifth, incorporates volume. Unlike some other oscillators, the MFI incorporates volume data, providing a more comprehensive view of market participation and strength of trends. Sixth, versatility. The MFI can be applied across different timeframes and is used in various markets including stocks, cryptocurrencies, and forex, making it adaptable for different trading strategies. Now, what is the best EMA period to combine with the Money Flow Index indicator? Moving averages are among the most effective indicators in the financial markets. They are widely used for analyzing various financial instruments such as forex, stocks, crypto, and commodities. The Exponential Moving Average, EMA, is a type of moving average that provides reliable results in identifying trends. In particular, combining the EMA with the Money Flow Index indicator has shown effective results. Among the various EMA periods, the 9-period and 21-period EMAs are considered optimal for this combination. Money Flow Index Trading Strategy. If you want to master the money flow index trading strategy, this is one of the most effective and easy to implement MFI strategies across all markets and timeframes. Although the default period for the MFI indicator is 14 periods, this strategy uses 21-period MFI and 9-period MFI instead. The reason for using 21-period MFI and 9-period MFI is to align with short-term trend movements indicated by the 9-period EMA and 21-period EMA. The advantage of using 21-period MFI and 9-period MFI to confirm trends shown by the 9-period EMA and 21-period EMA is that the Money Flow Index, or MFI, incorporates more complex formulations involving market volume. As a result, the trading signals generated are more accurate and reliable. Using candlestick and chart patterns. Now, another crucial aspect of money flow index strategy is identifying high-accuracy trading signals because trends and momentum are convincingly shown by the MFI and EMA indicators. Here are the candlestick and chart patterns that I believe are the most reliable in this strategy. The top 3 most popular chart patterns in trading are: first, head and shoulders pattern. This is a reversal pattern that indicates a potential change in trend. It consists of 3 peaks. A higher peak, head, flanked by 2 lower peaks, shoulders. A neckline connects the lows of the 2 shoulders. A breakdown below the neckline after the formation confirms a bearish trend reversal. Second, double top and double bottom patterns. These are also reversal patterns. The double top pattern forms after an uptrend and consists of 2 peaks, tops, that are roughly equal, separated by a trough, low, between them. The double bottom pattern forms after a downtrend and consists of 2 troughs, bottoms, that are roughly equal, separated by a peak, high, between them. A breakout below the low point between the tops, double top, confirms a bearish reversal, while a breakout above the high point between the bottoms, double bottom, confirms a bullish reversal. Third, flags and pennants. These are continuation patterns that often occur after a strong price movement, impulse. Flags and pennants are characterized by a consolidation period where the price moves sideways in a narrow range after the initial impulse. Bullish flag. A flag pattern forms as a rectangle-shaped consolidation period following an uptrend. It typically slopes down slightly against the prevailing trend. Bearish flag. Similarly, a bearish flag forms after a downtrend and slopes up slightly against the prevailing trend. Bullish pennant. A pennant pattern is characterized by converging trend lines that form a small symmetrical triangle. It represents a brief consolidation before the continuation of an uptrend. Bearish pennant. Conversely, a bearish pennant forms a small symmetrical triangle during a downtrend, indicating a brief consolidation before the continuation of the downtrend. These chart patterns are widely recognized by traders and analysts for their predictive potential in forecasting future price movements. The top 3 most popular candlestick patterns. The top 3 most popular candlestick patterns in trading are: first, hammer and hanging man. Hammer, or bullish pin bar. This bullish reversal pattern forms at the bottom of a downtrend. It has a small body near the top of the candlestick with a long lower shadow, lower wick. The long lower shadow indicates that sellers push the price significantly lower during the session, but buyers manage to bring it back up, typically closing near the high of the day. Hanging man, or bearish pin bar. This bearish reversal pattern is the opposite of the hammer. It forms at the top of an uptrend and has a small body near the bottom of the candlestick, with a long upper shadow, upper wick. The long upper shadow suggests that buyers push the price higher during the session, but sellers manage to bring it back down, closing near the low of the day. Second, engulfing patterns. Bullish engulfing. This pattern occurs during a downtrend when a larger bullish candle, the second candle, completely engulfs the smaller preceding bearish candle, the first candle. It suggests a potential reversal towards an uptrend. Bearish engulfing. Conversely, a bearish engulfing pattern forms during an uptrend when a larger bearish candle completely engulfs the smaller preceding bullish candle. It indicates a potential reversal towards a downtrend. Third, doji. A doji candlestick has a small body with an upper and lower wick that are almost equal in length. It represents indecision in the market between buyers and sellers. Depending on its location relative to preceding and following candlesticks, it can signal a potential reversal or continuation. These candlestick patterns are widely used by traders to analyze price action and make informed trading decisions. Understanding these patterns can help traders identify potential trend reversals, continuations, and market sentiment shifts. Now that we understand all the components of this strategy, let's begin applying them to execute trades in the market. Let's get started. Bullish trade setup. Place buy orders when these conditions are fulfilled. First, the blue 9-period EMA line crosses above the black 21-period EMA line. Second, the blue 9-period MFI line and the black 21-period line are above the 50 level. Wait a moment, you need to know this. As we can see on this chart, although the price appears to be in a downtrend, this strategy does not consider the trend as bearish because the black 21-period line is above the 50 level. However, the blue 9-period EMA line has crossed below the black 21-period EMA line, and the blue 9-period MFI line is below the 50 level. So now you understand what I mean by a valid bullish trend and a valid bullish trend, based on the money flow index and exponential moving average analysis. Let's move on to the next step, which is analyzing price action patterns. So, here are the price action confirmations that strengthen the likelihood of our trade position being successful. First, the price shows a bounce upwards after reaching a support area. This is the first sign that the trend is continuing its bullish direction. Such conditions often occur in the market. So, if you encounter this situation, be prepared to open a position in the direction of this ongoing trend. Second, a bullish falling wedge has formed, which means it's also a bullish signal in the price action chart pattern, because the price has already broken the resistance trend line of this pattern. After at least 2 price action confirmations have appeared, we can consider opening a buy position. So, in this case, once the candle that breaks above the resistance trend line closes as a bullish candle, you can consider opening a buy position. Don't forget to place a stop loss below the nearest swing low. Third, turns out, another bullish pin bar formed, followed by a bullish engulfing bar. So, you can open a second buy position with a stop loss below the nearest swing low. Indeed, this trade resulted in significant profits because 2 consecutive price action signals formed, while the money flow index and exponential moving average indicated a valid bullish trend. Based on my experience, the more price action confirmations that gather around a trading signal, the greater the chance that our trade position will be profitable. Therefore, do not overlook price action analysis in this strategy. Once you've identified a valid trend after completing the first and second steps, if I find multiple price action confirmations or confluence following these criteria, I seriously consider making a larger transaction. Bearish trade setup. Place sell orders when these conditions are fulfilled. First, the blue 9-period EMA line crosses below the black 21-period EMA line. Second, the blue 9-period MFI line and the black 21-period line are below the 50 level. After the price movement meets the first and second trading rules, the market is categorized as validly bearish. The next step is to conduct price action analysis to identify high probability sell signals. So, here are the price action confirmations that strengthen the likelihood of our trade position being successful. First, a strong support area is formed. Second, a bearish pin bar is followed by a penetration of the strong support area by a bearish Marubozu candle. Third, a descending triangle pattern forms, indicating a potential bearish trend if the support area of this triangle pattern is successfully breached by a bearish candle. In this case, the support area has already been breached by a bearish Marubozu candle. And like the first example that illustrated a high probability buy signal, this is a high probability sell signal. If I come across a trading signal like this or similar to it, I would consider entering a larger position, because the likelihood of achieving substantial profits is very high. You can verify this yourself in the forex, stock, or crypto markets. Now, you can open a sell position with a stop loss placed above the nearest swing high. Now it's your turn to put into practice everything I've explained in this great and reliable strategy. It's straightforward. Alternatively, in this video, I've included a template with the system that you can easily upload to your chart. It will automatically plot all these indicators accurately, so there's nothing for you to worry about. Find the download link in the description. As always, If you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell, and share this video across your WhatsApp, Facebook accounts, or X to show your support. See you next time.